Good evening, ladies and gentlemen. This is a special evening, I must tell you. As a believer of financial planning for masses, I'm truly excited to be among this people, sea of people which is full of real investment professionals who are believing in the same. The next 45 minutes that we are going to have today is going to be very, very special because today the panel that we have is a combination of experience, aggression, and professional diversity. We have representation from all three sides: fund management, we have business leaders, and of course, the distribution side. So we have an amazing combination which is going to give you greater insights into business. So without any further ado, let me introduce the panel and the professionals who are there. So to start with, we have Mr. Amitabh Mohanty. Mr. Amitabh Mohanty is the Managing Director of JM Asset Management. Mr. Mohanty can also be given the credit to start the movement of hybrid funds way back more than 2 decades ago. So Mr. Mohanty is a person who has been on the fund management side. He's been with SBI Mutual Fund. He's been with erstwhile Reliance Mutual Fund, now the Nippon Mutual Fund as the CIO did. Mr. Mohanty, I welcome you to the panel. Thank you so much, sir. And next we have Mr. Rahul Singh. Mr. Singh is the CIO Equity with Tata Asset Management. Mr. Singh, before joining Tata Asset Management, was the managing partner with Ampersand Capital Investment Advisors. Mr. Singh has also been associated with great institutions like Standard Chartered Securities and Capital Global Markets. We welcome you to the panel, Mr. Singh. We have Mr. Sandeep Tandon. Mr. Tandon is the CEO of Quant Asset Management, and also he's the Chief Thought Officer of Quant Group. Mr. Tandon is among the founding members of IDB Asset Management when it started. Mr. Tandon has got more than 3 decades of experience in this business. Mr. Tandon, we welcome you to the group. We have Mr. Sunil Subramaniam, again a professional with more than 3 decades of experience. Mr. Subramaniam is the Managing Director of Sundaram Asset Management. For more than 15 years with Sundaram Mutual Fund, he is of course associated with other reputed organizations like American Express, Bank of America, and of course Bank of India. Mr. Subramaniam is a passionate leader and passionate individual. I welcome you to the panel. With your aggression in panel, we look forward to many more fireworks in this discussion. Like I said, we have a diverse representation. We have 2 gentlemen who are part of our side, which is the distribution fraternity. You heard their names a while back while they came to the stage with their rank. So we have Mr. Jahangir Tankariwala, a senior banker, 22 years plus with HSBC. He's the one who jointly started private banking for HSBC. He's the one who has served HSBC in various markets across Asia. Mr. Tankariwala is a professional golfer. He's a passionate about sports. He's a passionate person in life, in his profession. He specializes in dealing with investors of his like. Thank you so much, sir. Welcome to the panel once again. And of course, we have Mr. Narayan Mehta, a professional with, again, an expertise with details. Mr. Mehta is a law graduate. He's a fellow chartered accountant, 25 years plus with experience in this field. Mr. Mehta has been part of a working committee for CBDT. He has worked in various market clients. He is serving many clients in various countries, US, UK, Norway, various other countries on the tax aspects of investment related. We welcome you to the panel, Mr. Mehta. So let me start the discussion with a warm-up question, because we've got rounds of questions from many of you. Thanks to all the people who are sitting here, we received loads of questions from you, and that has actually created a flow for our discussion. So let me start with the warm-up question, which is about, again, the Indian market. We are now in 2022. We have seen different phases. Once we sold 20 tons of gold to deal with certain uncertainties. We went through 2008 market. We've seen liberalization, globalization. opened the market for different economies. Now we are in a state where we are recovering from COVID and much faster than many other economies. So this is a question which is for all, including our distribution partners. I would like to ask, what do you foresee for India as a market specialist, as well as for the individual investors? A short brief view on this point. Let me start with Mr. Rahul Singh first.
Hi, thank you. I think the previous panel has talked in length about the India opportunity and how India is, all the stars are aligned. So I'm not going to repeat it, but I'm just going to tell you what we are seeing when we look at companies and when we are meeting companies. And I'll give you some anecdotes which I think will amplify those points, will further give proof for those points rather than trying to repeat the same things. I think it's phenomenal that when we meet companies in certain sectors, especially in manufacturing side, that we are seeing real first-hand evidence of some of the things which we only think are just gyan. It is not just gyan, it is actually happening on the ground. We are seeing a significant revival in the order books, in the capex cycle, both domestic and exports. The kind of feedback which we get from companies, I have never seen those kind of feedback in the last 10 years. And this I'm talking about large capital good companies, large industrial companies, large manufacturing companies. So it is actually happening. Whatever we were talking about in terms of theme, it is not just a theme now, it is actually happening. In fact, if you recall, this government had a Make in India kind of slogan, which actually did not work. But PLI is working. More than PLI, I think just the whole geopolitical scenario and the whole kind of global situation where there is a deficit of trust. There are companies looking for new source of manufacturing, new source of material, new source of supplies. And I think India is coming out very, very well. And also one thing which I wanted to highlight here is that now when generally the world is looking at India for the new supplies and new manufacturing capacity, they are not really bothered about cost. So they are not comparing necessarily with China and saying, China is still 20% cheaper, because now that is not really a criteria. And I think this is something which is a huge opportunity for India. So as I would say, India is getting a second chance. I think we missed the manufacturing boom between 1980 to 2010-20. Except for certain pockets where we did well. I think by and large we missed the manufacturing boom. Now we are seeing India getting a second chance, and I think we are seeing the government also realizing that India is a second chance. See, one thing is India is getting a second chance and none of us realize that India is getting a second chance. So after dropping a lot of catches, there is another catch coming your way, and this seems to be a simpler catch than any of the previous catches. And my sense is that the country is well capitalized to take advantage of that.
So I would request Mr. Tandon to share his views on it.
Thanks. I believe a lot of macro factor has been covered by our previous speakers. So let me quantify a few things which is more interesting. We strongly believe this decade belongs to Asia, and within that, Asia-centric emerging market and India in particular. Let me just quantify why we believe that, okay? If I look at more from a behavior perspective, the risk appetite for the developed market, okay, whether you talk about US, Japan, or even Europe as such, has peaked out. And very interesting is even the liquidity aspect, whether you look at the total liquidity or you talk about good liquidity, even that has peaked out globally. And where Asia risk appetite and liquidity is on the lowest level, which means money can shift from developed market to emerging market. And if I have to quantify a bit, let's say for next 6 quarters, if US market underperforms, and 10 to 15% liquidity can shift to India or Asia, you will see a tsunami out here, okay? And that is the big picture we are looking at. India is in a very unique position, okay? If I have to look at opportunity point of view, the manufacturing space, whether it's China plus, the challenges you see in the German market, okay, the European market is another opportunity which is emerging. Third most important aspect which people have not visualized right now about the Japan, the way currency is collapsing, I think the whole economy is about to collapse there. So another opportunity. So if you really look at India, so far we have talked about service sector opportunity. We believe next decade belongs to manufacturing, stocks, manufacturing activity can pick up. I think some of the earlier panel members talked about. That is a phenomenal opportunity. So we remain very constructive despite global headwinds which is there. We still believe the inflation and the interest rate will remain elevated for longer term perspective in developed market, particularly US. Whatever we have seen a small trailer in last many months, once this does settle down, I think bigger problems are there for global market, and India is in a very sweet spot. One more data point which talked about, which is more relevant from the distributor as a community or retail thing, every bull market has a leader. If you recollect, somewhere in the month of June 2003, when Indian market and global market started rally, India is the FIs was the driving seat. So they were the leader and they capitalized that opportunity till 2007-8. And then from 2012-13, August 2012, if I have to say, which lasted till January 2018, that bull market was led by the HNI's family office. They made extraordinary money. And the current bull run is started from March or April 2020 is led by retail, okay? And you can imagine the base retail has, this is a decade opportunity for retail people to make money. That give you a perspective, the opportunity as a mutual fund house or as a distributor what we have. So it's a phenomenal opportunity. This one decade belongs to India, and you can look for opportunity or the wealth which can be created in this decade. Thanks.
Thank you, Mr. Tandon. I'd request Mr. Subramaniam and Mr. Mohanty to add one more dimension to the opportunity side. Opportunity on the distribution side while we are moving this way. Mr. Subramaniam, to start with.
To me, every opportunity arises from the failure of the past. And I think at this point of time, when you say distribution, I think if you look at it as a nation, and I'm sorry to say this about the distribution community, is that we have had the best opportunity in front of us and we have failed to capitalize on it. What is that? That is, and I think Navneet mentioned about Jan Dhan Yojana starting, but even way before that, right? A massive proportion of our investors' money lies in bank deposits. And to me, bank deposits are the biggest wealth destructors for our country, and your customers have been destroying their wealth by putting in bank deposits. And as a distribution space, whether it's AMCs and distributors put together, we haven't taken advantage. We haven't gone and marketed to tell them that a country which has seen an average 7% inflation and had an average 7% savings term deposit rates, their wealth hasn't grown by locking it up, all because of what? Nationalization of banks, giving banks that kavach of complete security and no risk of failure. That fear of failure is what we haven't capitalized. And today, I think that's the opportunity which Sandeep mentioned, right? Which started from March 2020 when finally bank deposits collapsed to 4%, is when they realized the advantage. And today, that moment is for us to seize. And I think increasing the wallet share of each customer use service itself will be enough to triple your AUM even in the next 12 to 18 months. So I think you don't need to look beyond going and doing proper asset allocation to your customer, getting his trust to tell you how much he's putting in bank deposits. The biggest thing that he comes to you and tells you, I have this much to invest. Forget about that. Ask him how much is he saving, right? Tap into that pool, and I think the opportunity is humongous for our distribution community.
Thank you. That's very well said. Thank you.
So we have heard a lot from Navneet, Vishal, my respected panelists here, about how it's an India decade and how every stars are being aligned for India. Would like to just put a slightly discordant note here. Is like Navneet said, the world has become a much more uncertain place. And with uncertainty comes volatility. With volatility comes drawdown. And today the role of the distributor, and I'm not talking about technology, I'm not talking about various interfaces, you are the most important person for the retail investor. You are like, should I say, the family physician of each family. You know the risk profile of your investors the most. You know more than anyone else the family profile, where he's investing, what he's investing. And while no one disputes the long-term India story, to actually benefit from that story is when you survive volatility and stay invested for the long term. And that is where I think all of you should focus going forward. And I see a lot of debate happening in the industry about direct investments, regular investments, passives, actives, all those things. I think going forward, as the world becomes more volatile and we being a large player on the global stage, we will not be left unimpacted by volatility. I think the role of all you financial advisors will be very, very important. And this is where, as I say, from a different perspective, is your make and break platform. That if you navigate and help your investors navigate through the coming few volatile quarters, I think you'll gain their trust, their wallet share, and their long-term association with you. Thank you.
Thank you, Mr. Mohanty. I'll come to Mr. Tankariwala and Mr. Mehta, again for the same question but different perspective. Investor segment, investor psyche, and the opportunity on that side. So if you may.
So basically, let me bring this to you from the customer side. There was this discussion about volatility, we touched about volatility. I think the change that I am seeing as far as clients are concerned is an education on equity markets and volatility in particular. My clients, believe me when I tell you this, my clients actually chase me to invest more when the markets have corrected. There was a time when it was said that advisors run for the hills when the markets collect because your clients are going to call you and start chasing you and saying, what's happening? But this new dimension I have seen where people are willing to accept volatility and willing to understand that volatility is what really gives you the opportunity to enter the market at lower levels and therefore ride on when markets increase and get better. The second significant point I've been seeing from a client's perspective is with the ultra high net worth clients that I deal with, this requirement of having great exposure to overseas markets, albeit limited by the LRS values that we are limited to, of $250,000 a year, it seems to be reducing. They're not worried about India. They're not worried about taking their money overseas. They're not worried about the rest of the world providing fabulous avenues for return. They're very, very confident and bullish on India. This is something that I've seen in the last maybe 12 to 18 months. Some of my ultra high net worth clients, but it was a great passion that we want to go and get overseas citizenship and give up Indian passport and become an OCI. A lot of them have just changed their mind suddenly. Everything is very, very passionate. India, India, India. And I think while this side talks more from the supply part of things, the client is where the demand comes from, and I'm seeing a great growth in demand. So I think we have good times ahead. Thank you.
Thank you, Mr. Tankariwala. Mr. Mehta. Yeah.
We've heard all the doyens of the industry, the leading luminaries on the panel. So I would not talk further in terms of why India is in a sweet spot. We've heard about the 5Ds and the 3Gs and the 3Ps, etc. At a client level, I agree with some of the views that Jahangir has shared. And in fact, with my own clients, I've seen that happen over the last 2 years, where clients have been, who were wary of the fact earlier in terms of asset allocation, who were highly tilted towards real estate, towards gold, towards equity. They are realizing the importance of equity as an asset class and the only asset from a long-term compounding perspective. And I've seen clients who are actually now willing to liquidate their FDs. They're willing to, even take out a portion from their PPF. From the conventional wisdom always suggested that debt equity, always the debt part of investments made more sense. But clients are using volatility to take this as an advantage. In fact, there are clients who are sitting with dry powder, wanting to deploy. So I think it's a wonderful, fascinating game we have. And I think as time passes by, more and more funds will keep coming. And India has a wonderful prospect ahead, is what I feel.
Thank you, Mr. Mehta. Friends, I was chatting with Mr. Tankariwala a while back. He was very passionately talking about one point: active funds versus passive funds. This is a new trend. Mr. Tankariwala, would like to ask that question, please?
Actually, I would like to address this to Rahul and Sandeep both, and let's start with Rahul. As economies develop, as financial markets develop, like in the US, for example, in the West, there's a serious gravitation and movement towards passive investing. The index funds run by Vanguard, Jack Bogle has always spoken about index funds being the place to be. Warren Buffett says that when I am gone, I've told my wife that she must only invest in index funds. So, if you look at the index itself, if you look at the Sensex over the last 40 years, we've seen, I may not be very precise, but close to between 15%, 14.5% to 15% of compounded growth. If you're patient, and with the miracles that compounding provide, at 15%, so when we talk about, I think I was doing a little calculation somewhere and I saw Sensex in 1978 was at 140 and we're talking about close to 60,000 levels now. What is the future in the country for active funds?
Thank you for this question. I'll give you my thoughts, which some of them are quite blunt in the sense that, when you look at a country like India, when we are looking at a scenario when we agree whether it's 5 years, 10 years, 15 years, with some ups and downs that it's going to be a huge period of economic growth, there is no way that passives will do better than active. Because when economies grow and economic growth becomes broad-based, we get much more choice to pick up stocks and sectors, which is not the case if economies are not growing. Point number one. And India is definitely not in that camp. Number two is what we have seen last 10 years is that the interest rates have been only going down and valuations have only been going up. Now that the interest rates have gone up and will probably stay there for a longer period of time, markets are going to be more mixed, which means that you will have to have a bit of value, bit of growth at reasonable price. You can't just have quality, momentum, and stuff which works. Momentum works on passive works on momentum. So those things are getting broken, and Sandeep can talk more about it. He breathes this in and out. And if you look at it's the beginning, you can see the beginning of that in the last 1.5 years, and I feel very passionately about it, that the tide is turned. We saw 2017 to 20 fine, but that was a one-way directional market. Now things are changing, and some of our funds, even in long term, like one of our oldest fund, Tata Equity P, is 18% in 18 years. We call it 18 in 18. It's far better than Sensex. Last 1.5 years, a lot of our funds are beating benchmark handsomely, and when I give the mic to Sandeep, he'll throw up even bigger numbers. His funds are beating the index even more handsomely. So I think the debate was a bit overdone. For a country like India, I think it's too much ahead of time, in my view.
So I just take it forward. What Rahul has said, I agree with you, with Rahul completely. Let me give you some perspective in numbers, okay? If you look at the success of a passive fund, particularly if you talk about phase in 2012 onwards in US, okay? It was the one-way secular bull run, okay? Which lasted till September, October 2021, and which is the phase where passive fund has done extremely well. Okay, and given the size, because I also look at from the behavior perspective, there is no emotional attachment in the passive investing, and that was the phase which played out. And in India, people have followed that. Okay, the passive has done well, but it is a failure of Indian active fund manager. Okay, in that period, that's the way we defined it. Okay, now let's look at going forward. 2021 onwards, September 2021, if I have to say for this decade, that this decade is going to be very challenging given the headwind which we are facing globally. So it will not be easy phase. And if it's not the easy phase, this is the time for active fund manager to come back. Okay, so I think active fund manager, if you look at in last, let's say some September, October 2021, from November 2021, we'll say till today, I think active fund manager has done far better job than the passive. They have outperformed significantly. And that's the way we defined it. I think this decade belongs to active fund manager. Okay, so we should not get confused with just for the cost of transaction is small, and that's the reason I will go for passive style of investing. Okay, but in this volatile and uncertain world, the active fund manager will deliver superior return or superior risk-adjusted return versus passive.
Thank you both of you.
Mr. Mehta, I think Mr. Mehta represents our distribution side once again. So he had certain questions regarding the platforms and yeah.
I have a procedural questions in terms of the compliances, and I will like to address this to Mr. Sunil Subramaniam. So, the industry has come a long, long way since 1995 in terms of where we are today, and whether we look at it from the product construct point of view or the operational efficiency or overall, the way the industry has moved on various parameters, the industry has done a phenomenal job. But in terms of processes or, when it comes to updating certain non-financial transactions on various platforms, there is still different processes which are followed by different industry platforms today, whether it's BSC Star or NSC Star or, even the respective RTAs platforms, So what are the efforts which the industry is putting in at this stage to ensure that the process is streamlined from the investor's point of view?
I couldn't agree with you more. I think what's happened is that the industry has been multiple counting investor folios for generations now. So the fear is that a consolidation of these folios, if you use PAN number across industry, the size of the industry will collapse. So it's still that internecine rivalry between inside a pack of lions, which has led to this. It's definitely not a good thing from an investor perspective. And I think the regulator has made the first beginning with this MF Central project, where he's asked both the RTAs to consolidate. And I think that there is a short-sightedness in the industry from the manufacturing side, the fear of competition, the fear that each one of our bosses would say, why suddenly your folio count shrunk. That is what is hindering this. I think there needs to be a little bit of maturity and a longer-term investor-focused approach here, which might lead to a collapse of the number of folios. But ultimately, I see the El Dorado, the point of arrival, as when you redeem from one AMC and invest in another AMC, it should be a switch transaction. It need not be a T+2 redemption transaction. I think that's something the industry has to steel itself and get the courage to look beyond these battles and go forward. I am happy to admit that as a failure of our industry from a customer perspective. In fact, simplification is the need of the hour. And even with the industry, if you see, the moment SEBI came with categorization, we came up with new techniques to launch new NFOs. ESG was a flavor, now business cycles is a flavor. The regulator is trying to say simplify, we are finding ways. And that's because of competition coming, and it's a very natural process. While I'm saying the industry is at fault, it's also a part of the growth. We only have 45 AMCs for a population of our size. So I think that this process of consolidation will ultimately lead to this. But yes, a sea change, I'm first to admit, needs to occur where the industry needs to put the investor at the center of the piece and make transaction processing as simple at its end. And To some extent, pooling was a methodology, but because of the things that happen in the stock market with brokers, that got. Otherwise, pooling is also a way the industry could have a large pool where everybody could transact through a pool. Then that would have been also a good point. But I think that's not going to be the way forward. So I think, yes, there has to be a concerted effort by the industry to put the customer at the center and simplify processes much, much better. And that will then improve penetration and the pie will become that much larger. So I agree with you that we have so far not done the best by the investor by having a complicated series of KYC processes, redemption processes, non-financial transaction processes. I'm the first to admit that there's a lot of work to be done there.
Thank you.
Thanks, sir. I have my next question to Mr. Mohanty. This is regarding regulation-induced reduction in earning of all our intermediaries, especially in mutual fund side. So while we are aware about the fact, what view I'm looking forward from your side is how, because we all are in a business of compounding, how our intermediaries work towards their business in such a way that their business also grows compounded and that even continuously. I'll come to you, Mr. Subramaniam, also with this thought. Yeah, Mr. Mohanty to start.
I think when we talk about India developing as a financial global leader, I think as intermediaries and as advisors, we all need to be very, very knowledge focused. You will see new innovations coming in the financial world. You will see more retailization of new financial products. And the only way we stay relevant and stay ahead of the curve is by constantly upgrading ourselves, adding value to the portfolios of our investors. And the way I see it, the first phase of learning in the industry has been done. I think the next phase is coming. More financial products, more financial assets. See, that way, if I look at it from an industry perspective, I think a lot of the distribution community is largely focused on equity assets, okay, in mutual funds. Now that itself is going through a sea change with newer products coming in, newer fixed income products coming in, which I think in the next 2, 3, 4 years, given interest rates moving up, given higher volatility, will start forming a larger part of investors' portfolios, and therefore it is for all of us to understand how fixed income products behave in a volatile world. And as I said, SEBI is also trying to categorize various financial platforms. You have the PMSs of the world, you have the AIFs of the world. As our investors start doing better and better, and in lots of cases, a lot of our HNI investors, ultra HNI investors, a lot of these products can be offered to them by better understanding from our side. So we should not worry about the squeeze in the margins. I think we should upgrade ourselves, evolve ourselves to look at new financial products and be ready to offer them to our investors. I think that's the way to go.
Thank you. Mr. Subramaniam.
When SEBI removed upfront commissions and entry loads and exit loads and all of those, right, the industry was uniformly unhappy. The manufacturers, because they had a biscuit to give to the Pavlovian dog to go and get business for itself. The distributors felt that the cost of acquisition of a customer, which was being defrayed by the upfront, went away, right? So there's unanimous negative thoughts around that. Today I would argue that that was the best thing that the regulator did for the industry, right? Why? Because of two things. Remember, there's a price for everything. Upfront commission was coming to you at the cost of a lower subsequent year trail. Please do not forget that. The assets that you got during the upfront period are earning far less today to you than those which are acquired in the trail commission period. That's number one. Number two is the fact that if you look at it, it's a price into quantity. everybody, the sales value of any company is priced into quantity, right? This commission is only the price. But I think if you see, quantity has a far greater contribution to absolute revenues than price at any stage, right? And how can you improve the quantity? First, I think what Mr. Mohanty said here, first is that do not focus yourself only on equity products, right? There are a range of products available, but for that, the mindset change that you need to bring in is don't think that you can try to earn 120 basis points or 100 basis points from every asset that you tap from the investor, right? You've got to say that, can I increase my penetration of the customer's wallet? And I go back to my earlier point, there's a huge amount of the customer's money which he's putting away with your knowledge in bank deposits, where you are earning zilch. A small shift of the penetration of the wallet, and for that you don't have to think that I will take that bank deposit money and put it into equity, thereby converting 0 to 120. No. Think about it, that if you can get that money into company fixed deposits, if you can get that money into insurance, you can get that money into debt products. If you make 40, 50 basis points annualized from that, that is a huge additional source of income. So my sense is that if you focus on the quantity and not on the price part, your future, you can rewrite your own future. Like I said, increasing penetration of the customer and selling the right products. Because the second point which I wanted to tell you is that ultimately a customer's future lies in your hands through proper asset allocation. There was a discussion about active and passive. It's you who are deciding the right asset allocation for the customer to not only grow his wealth, to meet his financial needs, to do goal planning, to do financial planning. All of that is in your hands. So if you then look at the entire customer's portfolio and arguably advise him on his bank deposit exposure. Even if you don't make money, position yourself as the advisor of first choice to the customer. And if you're advising him on 100% of his portfolio, whether it comes to gold, whether it comes to bank fixed deposit, savings account, the trust that you gain and the market share and the wallet share you will gain will far compensate this reducing price impact which you are fearing. So to me, focus on the quantity, and that will take care of your future, which will be even brighter and brighter as customers. India is poised to go from a $2,300 per capita income to $4,700 by the end of this decade. And arguably, when a person goes from $2,000, which is a lower middle income country, to $4,700, which is a higher middle income country, the proportion that goes into savings will be far higher than the proportion which goes into consumption. So you are sitting on an absolutely pata wicket in cricket terms, right? For you to just focus on quantity, quantity, quantity. Forget about price. Price will come and take care of itself. That's my humble submission.
Thank you, Mr. Subramaniam. I'll take the last question now. In fact, I'll point it to Mr. Tandon. This is about the investment biases. We as intermediaries, we deal with clients where we see the investment biases or behavioral biases of the investors. I'd like to request you to throw some light on the investment biases of the fund management side. Do you deal with it? What to buy, what to hold, or what to sell? Your thoughts. And how do you do that?
Interesting question. We have been dealing with this, for a while. I see the way we look at, though we have been taught, we should never get married to a stock, never get associated, attached, but it never happened in real life, Whatever reasons you have made money in particular stocks, sectors, or certain promoters, certain styles, certain theses, you get associated. And that is the biggest challenge which I find maybe in last 30 years. This is something which we are trying to evolve at Quant Mutual Fund, is that how to remove these human biases. That's the way we build processes around that. Everything has to be quantified. The moment if you can get into a thesis that everything has to be quantified, every number has some value, then you can do a better job, and then you can remove these biases which is there. Otherwise, people live with this is my idea, this is my experiences, this is what the brokers are telling, this is the best analysts are talking about, and this is the way industry is building up. So I think the challenge for us is if you can remove these biases, that's the best outcome. And this is something which we have trying to attempt at Quant.
Thank you, Mr. Tanan. Mr. Singh, would like to add something to the point?
No, I would just add to Sandeep, it is the toughest thing to do. And when the styles change from growth to value and so on and so forth, it's important to be with a fund manager who understands that and adjusts to that. Someone might use models to do that. Somebody has to use own introspection to do that. But I would just add to the point which he made and just go back to the passive question, that passives are the worst form of bias, because you are going after what is working, or what is working, so you're just getting habituated by that steroid. But when it turns, the same thing can hit you, because there will be huge outflows if there is so much money riding on that. So I think the questions are related, is what I would is the only thing I would like to add.
Thank you, Mr. Singh. So I'll have one quick rapid fire questions to everybody. One word, one term that comes to your mind when we talk of investing. Only one word. Mr. Singh, starting with you.
I have to start?
Just one word.
Flexibility.
Flexibility.
Dynamic. Should I elaborate?
That's about it. Thank you.
It has to be two words. It's long term.
Okay, great.
Freedom.
I was going to say, well, anyway, he said long term. I was going to say patience, but that's it. So I'll say purchasing power, even though it's two words.
Terms, yeah.
I'll only say Chak De India.
Fantastic. So with this, we come to the end of this panel discussion, which of course, like I said, represented three sides of our industry: the manufacturing, the leadership, business leadership, and the distribution. So thanks to all the panel members, and thanks to the audience for having a patient listen. Thank you so much. Thank you.